Hi, everybody. Today we are going to analyze one of the largest companies in the world, which is listed in the Fortune Global 500 list in 2013, as well as the biggest private employer in the world with over 2 million employees, and the largest retailer in the world. That is Walmart. Walmart began trading stock as a publicly held company on October 1, 1970, and was soon listed on the New York Stock Exchange. The first stock split occurred in May 1971 at a market price of $47. Currently, it appears to be fairly valued at a $77 of share price. Walmart 3 operating segments, which are Walmart US, Walmart International and Sam's Club, are projected to add between 36 million and 40 million retail square feet for fiscal year 2013. 2 fundamental operating principles: everyday low cost, EDLC, and everyday low price, EDLP, underpin their ability to grow profitably. Being a member of multinational corporation MNC, our team is entrusted with 1 million ringgit to be utilized for investment purposes. In order to be responsible for our company's shareholders, our team has made the following analysis for Walmart financial statement. According to Walmart's the latest 3-year annual report, we have analyzed the following financial ratios. First, current ratio. Current ratio measures whether or not a company has enough cash or liquid assets to pay its current liability over the next fiscal year. The ratio is regarded as a test of liquidity for a company. From above calculation, we can see that Walmart has 0.83 times of current asset to meet its requirement of current liabilities in 2013, and 0.88 and 0.89 times of current asset to meet Walmart's current liabilities in 2012 and 2011, respectively. By comparing the 3 years' current ratios, we can get that Walmart's current ratio deteriorated from 0.89 times in 2011 till 0.83 times in 2013, showing a consecutive decline in the past 3 years. Second, quick ratio. Quick ratio measures the ability of a company to meet its short-term obligations with its most liquid assets. Therefore, the ratio excludes inventories from current assets. In general, the higher the ratio, the greater the company's liquidity, the better able to meet current obligations using liquid assets. Walmart has 0.22, 0.23 and 0.27 times of its most liquid assets to meet the requirements of its current liabilities in 2013, 2012 and 2011, respectively. By comparing the 3 years' quick ratios, we can find that Walmart's quick ratio deteriorated from 0.27 times in 2011 till 0.22 times in 2013, showing a consecutive decline in the past 3 years. Even though there are lower both the current ratio and quick ratio, we cannot say Walmart did not perform well because as investors, they may prefer a lower current ratio since they are more concerned about growing the business using assets of the company. If a business has large amounts in accounts receivable, which are due for payment after a long period, say 120 days, and essential business expenses and accounts payable due for immediate payment, the quick ratio may look healthy when the business is actually about to run out of cash. In contrast, if the business has negotiated fast payment or cash from customers and long terms from suppliers, it may have a very low quick ratio and yet be very healthy. Therefore, according to the nature of business of Walmart, we can say that Walmart have a healthy current ratio and quick ratio. Next is inventory turnover. From the table, we can see that Walmart is able to sell off its inventory for 8.43 times, 8.69 times and 9.11 times per year in 2013, 2012, and 2011 respectively, which shows that the inventory turnover deteriorated from 2011 to 2012 and from 2012 to 2013. Average collection period. By looking at the table, we can see that Walmart is able to collect its payment every 5.27 days from its credit customers in 2013, 4.85 days in 2012, 4.40 days in 2011, which shows an increase about Walmart's average collection period in the past 3 years. Total asset turnover. Total asset turnover measures the efficiency of a company's use of its assets in generating sales revenue or sales income to the company. Generally, the higher the company's total asset turnover, the more efficiently its assets have been used. we can see that for every $1 worth of assets utilized, Walmart can generate 2.31 times of sales in 2013. The company can develop 2.31 times of sales in 2012 and 2.33 times of sales in 2011. From the figures, we find that there is a slight decline about Walmart's total asset turnover from 2011 to 2012 and the same from 2012 to 2013. Debt ratio indicates the percentage of a company's assets that are provided via debt. Therefore, Walmart has 59.76% of its total assets being financed by debts in 2013. In 2012, there is 60.83% of its total assets being financed by debts. 60.59% of its total assets being financed by debts in 2011, which tells us that Walmart's debt ratio slightly deteriorated from 2011 to 2012 but improved from 2012 to 2013. Times interest earn ratio called coverage ratio measures the company's ability to make contractual interest payments. For Walmart, it has 13.45 times of ability to pay off its interest in 2013. 12.30 times and 12.75 times to pay off its interest in 2012 and 2011, respectively. Looking the figures, we can see that Walmart's times interest earn ratio deteriorated from 2011 to 2012 but improved significantly from 2012 to 2013 and above 2011 level. Gross profit margin is used to assess a firm's financial health by revealing the proportion of money left over from revenues after accounting for the cost of goods sold. Gross profit margin serves as the source for paying additional expenses and future savings. In other words, it measures the percentage of each sales dollar remaining after the firm has paid for its goods. From the table, we see that for every $1 of sales, Walmart generates 24.87 cents of gross profit in 2013. 25.02 cents and 25.34 cents of gross profit in 2012 and 2011 respectively. Why? That tells us Walmart's gross profit margin dropped from 2011 to 2012 and from 2012 to 2013. Operating profit margin measures the percentage of each sales dollar remaining after all costs and expenses other than interest, taxes, and preferred stock dividends are deducted. Looking the table, we find that for every $1 of sales, Walmart generates 5.93 cents of operating profit in 2013. 5.94 cents and 6.05 cents of operating profit in 2012 and 2011 respectively, which means Walmart's operating profit margin dropped from 2011 to 2012 and from 2012 to 2013. Net profit margin measures the percentage of each sales dollar remaining after all costs and expenses, including interest, taxes, and preferred stock dividends are deducted. The table tells us for every $1 of sales, Walmart generates 3.62 cents of net profit in 2013. 3.51 cents and 3.89 cents of net profit in 2012 and 2011 respectively. By comparing the past 3 years' net profit margin, we find that Walmart's net profit margin declined from 2011 to 2012, but improved from 2012 to 2013. Earnings per share represents the number of dollars earned during the period on behalf of each outstanding common stock. Looking the table, we see that for every $1 of common stock equity, capital invested by common stockholders, Walmart is able to earn $5.04 for them in 2013. $4.54 in 2012 and $4.48 in 2011, which shows an increasing from 2011 to 2013. Return on total assets measures the overall effectiveness of management in generating profits with its available assets. From the table, we get that for every $1 of assets owned, Walmart is able to generate 8.37 cents of returns to common stockholders in 2013. 8.12 cents and 9.07 cents of returns to common stockholders in 2012 and 2011 respectively. By comparing them, we can find that Walmart's return on total assets dropped significantly from 2011 to 2012 but then improved from 2012 to 2013. Return on common equity measures the rate of return on the ownership interest, shareholders' equity, of the common stock owners. It measures a firm's efficiency at generating profits from every unit of shareholders' equity, also known as net assets or assets minus liabilities. ROE shows how well a company uses investment funds to generate earnings growth. Looking the table, we find that every $1 of capital invested, Walmart can generate 22.27 cents of returns to its shareholders in 2013, 22.01 cents and 23.91 cents of returns to its shareholders in 2012 and 2011 respectively, which means Walmart's ROE declined significantly from 2011 to 2012 but then improved from 2012 to 2013. The price-earnings ratio measures the amount the investors are willing to pay for each dollar of a firm's earnings, indicates investor confidence. From the figures, we see that Walmart investors are willing to pay $14.84 for each dollar of Walmart's earnings in 2013. $13.46 is paid by Walmart investors for each dollar of Walmart's earnings in 2012. And $11.69 paid for each dollar of Walmart's earnings in 2011 that tell us the price-earnings ratio increased from 2011 to 2012 and from 2012 to 2013. The market book ratio provides an assessment of how investors view the firm's performance. By looking the tables, the investors view the firm's performance as 3.30 in 2013, 2.96 in 2012 and 2.79 2011. From these figures, we can see that Walmart Stores Inc.'s market book ratio increased from 2012 to 2013 and from 2013 to 2014. From the table for summarizing Walmart's the latest 3 years financial ratios, we can see that, even though Walmart has a slight underperformance, but we still can see that, out of 16 financial ratios we analyzed, there are 7 ratios showing increasing trend in the debt ratio decline. Despite Walmart's underperformance, its commitment to increasing shareholder value has not changed. From Walmart's annual report, we can get that since 2009, the company has increased its earnings per share by 59% and its free cash flow by 123%. During that same time, the company has returned $60 billion to shareholders in the form of dividends and share repurchases. In fact, Walmart has increased its annual cash dividend every single year, since first declaring a 5 cents per share annual dividend back in March 1974. That's 38 years of consecutive annual dividend increases. So, they still did a good job, and their business is keeping going well. We believe that Walmart can provide strong returns to the shareholders in the following years. Therefore, our team suggests shareholders to invest 1 million ringgit to Walmart Company.